Oh my God, this can't be right.
In January 2026, your net deposit can shrink with no pay cut, worker or retiree, because new rules pull cash first. Two forces drive it: Medicare premiums and IRMAA for retirees, plus mandatory Roth catch-up taxation for many workers. In this video, you'll see what changed, who gets hit, and how to keep monthly cash flow predictable. CMS set the standard Medicare Part B premium for 2026 at $202.90 per month, up $17.90 from 2025. CMS also set the 2026 Part B deductible at $283 before coinsurance applies to most outpatient services. SSA announced a 2.8% Social Security COLA for 2026, affecting about 75 million beneficiaries and SSI recipients. Medicare premiums are deducted from benefits, so your COLA can vanish before you pay groceries, rent, or gas.
Is this what I worked my whole life for?
Higher earners may owe IRMAA extra surcharges added to Part B and Part D premiums and deducted monthly. Social Security sets 2026 IRMAA using your 2024 tax return because it uses a 2-year lookback. The IRS reports your tax-exempt interest, and Social Security adds it into MAGI for IRMAA. This is what triggers higher Medicare surcharges. In 2026, IRMAA starts above $109,000 MAGI single and above $218,000 for married joint filers. IRMAA has multiple tiers, and even one extra dollar can push you into a higher premium bracket.
Oh no.
On the worker side, Secure 2.0 requires Roth catch-up contributions for certain higher earners starting in 2026. The IRS issued final regulations so retirement plans can implement Roth catch-ups and updated catch-up limits correctly. Now the consequence begins. Your paycheck can get smaller, and your benefits deposit can get smaller in January. That smaller net can hit the same week as insurance, prescriptions, or rent, turning everyday life into tight math. When cash gets tight, people reach for credit cards, and interest quietly multiplies the damage every month. Others sell investments for liquidity, and that sale can raise MAGI, setting up higher IRMAA later. This is timing risk, not fear. The rules price future costs from past income decisions, whether you notice.
And what should we do now?
Here is a unified step-by-step plan. Inside each step, we cover retirees first, then workers. Step 1, Snapshot. Pull your 2024 tax return, your latest statements, and your most recent pay stub. For retirees, compute IRMAA MAGI as AGI plus tax-exempt interest, then compare it to the 2026 tier thresholds. Write your number down and flag if you're within a few $1,000s of any cutoff. Near a cutoff, build a cushion, because dividends, interest, or late forms can cross it by accident. For workers, confirm your 2025 FICA wages with Payroll, because that decides Roth catch-up treatment for 2026. If wages exceeded $150,000 with the same employer, expect Roth catch-ups unless your plan documents say otherwise. Also confirm your age category because catch-up limits differ for ages 50 plus and ages 60 through 63. This snapshot takes 10 minutes, but it prevents weeks of confusion when the first January deposit arrives. Step 2, verification. Confirm what will be deducted automatically so you're not shocked on deposit day. For retirees, verify whether Part B is withheld from Social Security or whether you will be billed separately. Locate the Part B line and any IRMAA line, then total your monthly Medicare deduction amount accurately. Treat that total like a fixed bill, because it's deducted before you ever touch the money. For workers, ask your plan administrator whether Roth catch-ups auto-switch or require consent, then set reminders now. If consent is required, complete it immediately because missing it can suspend catch-ups for the entire year. If your plan lacks a Roth option, confirm whether catch-ups are blocked, then redirect savings elsewhere quickly. Do not assume HR will warn you. Many people notice only after the net line drops. Step 3, cash defense. Build a buffer equal to 2 months of the expected increase before bills hit. For retirees, keep that buffer in cash so you do not sell assets during a market dip to pay premiums. If benefits fund essentials, consider a separate account for Medicare deductions to reduce emotional shock each month. For workers, treat the Roth tax hit like a new fixed expense and cut spending before the first smaller check. If net pay drops, avoid solving it with revolving debt because interest costs amplify the policy change fast. A buffer is not pessimism. It buys calm, and calm prevents panic selling and missed payments later. Step 4. Timing control. Manage income events that change MAGI because IRMAA uses old returns to price you. For retirees, spread significant capital gains across tax years when possible to avoid a tier jump by $1. Track municipal bond interest separately because it counts for IRMAA even when your taxable income looks low. If you consider a Roth conversion, model its IRMAA impact before converting, not after the letter arrives. For workers, coordinate bonuses, RSUs, and side income with your CPA because these can also raise future IRMAA. Also coordinate withholding and benefit elections because higher taxable wages can change credits, brackets, and phase-outs. Timing control is about choices made now to avoid paying a 2-year echo in premiums later. Step 5. Corrections. If the system prices you wrong, respond fast with documents, not frustration. For retirees, if income dropped from a qualifying life event, file SSA 44 quickly and keep copies of everything. Do not assume capital gains qualify. Most gains and Roth conversions are not accepted life events for IRMAA relief. If you amended a return for a fundamental error, request that SSA reassess premiums using the corrected IRS data. For workers, watch Paystub lines for Roth catch-up, higher withholding, and lower net, then confirm settings. If payroll-coded catch-ups are incorrect, open a ticket immediately, as retro fixes can take multiple pay cycles. Corrections are easier when you move quickly, while payroll vendors and plan administrators still remember context. Step 6. Monitoring. Once a month, compare planned net cash to actual deposits and adjust before damage spreads. For retirees, compare December and January deposits. Label each deduction, then track changes quarterly as tiers update. For workers, compare December and January pay stubs and investigate any silent switch that payroll never explained clearly. If the net drops, fix it the same week because waiting creates overdrafts, missed payments, and avoidable late fees. Remember, IRMAA is enforced through withholding, so you cannot ignore it. You must plan around it annually. And payroll systems execute rules without emotion, so your defense is to check, document, and verify monthly.
Y'all got any more bad news?
For 2026, the IRS raised the 401 key elective deferral limit to $24,500 for most workplace plans. If you are age 50 or older, the standard catch-up limit is $8,000, raising your possible total contributions. If you are ages 60 through 63, Secure 2.0 allows a higher catch-up limit of $11,250 in 2026. Those higher limits help retirement, but they also make the tax timing shift larger, so cash planning matters more. If you support family, communicate the net change early because hidden deductions can create conflict at home quickly. If you run a business, avoid big income spikes near year-end unless you accept the future IRMAA pricing impact. If you feel behind, do not quit saving. Adjust gradually and protect essentials first, then rebuild momentum. The win is simple. You notice changes early, so January feels boring, not like a surprise financial emergency. Example retiree, you sold stock in 2024, and in 2026, your Medicare deduction rises without warning in January. Example worker, you elected catch-ups, crossed $150,000 in wages, and your net pay drops because taxes are withheld immediately. Use one rule. Never let a new deduction hit you blind. Verify deductions before building next month's budget. Keep one folder with your 2024 return, pay stubs, plan notices, and Medicare letters so appeals are easier later. If you call SSA, write the date, the agent name, and the reference number, so follow-ups stay consistent. If you call your plan administrator, ask what happens if you do nothing, because defaults differ across vendors. Your goal is boring predictability, stable cash flow, steady savings, and no surprises that force asset sales. Comment whether you are working, retired, or both, and share your income band for 2024 and 2025. Next episode, we'll walk through a real pay stub and a benefits deposit, labeling every deduction line by line. It is educational content only. Verify CMS, SSA, and IRS guidance and consult professionals before acting on your numbers.
I gotta tell you, I really hate watching this channel sometimes.